In this question, we will calculate first the expected returns of stocks A and B. Then we are going to calculate the standard deviations and then look at the coefficient of variation. Then figure out which stock offers a better risk-return trade-off. We will do the same thing by using Sharpe ratio. And then we will answer the last question and see if the coefficient of variation and the Sharpe ratio provide consistent investment advice. For instance, if coefficient of variation is telling us that the asset A offers a better risk-return trade-off, we will check whether Sharpe ratio agrees with that advice. We hope or we expect them just to be in agreement because they are pretty much the same type of indicators. So the expectation is that they should work and they should have consistent advice for us. So let's start with the calculation of the expected returns. You may remember that the expected returns are essentially probability weighted outcomes. So we calculate the probability times the outcome for all range of probabilities and we add them. So we used a model where we showed the expected returns as sum of probabilities times the expected or the particular outcome associated with those probabilities. So we have a situation, let's say state of the world, where the probability of occurrence of that state of the world is 10%, and if that turns out to be the case, or if that state of the world emerges, there is going to be a minus 10% return. I mean, this might be a situation where we might, the economy might be in a recession. So if that is the case, we will multiply the probability and the outcome. But there are many other possible situations that might occur. As you can see, the sum of all of these probabilities adds up to 1. That means that they cover the 100% of the possible situations. So there's a 10% of possibility of earning a minus 10% return. There's 20% possibility of earning a 2% return. 40% probability of earning a 12% return, and 20% probability of earning a 20% return. Again, a 10% probability of earning a 38% of return. So with these probabilities and this possible outcome, what is the expected return? Expected return is weighted average of these outcomes, and we calculate them. Let's look at it in here. Let's create a column in here and say that probability times outcome for stock A. So let's enlarge this. And we are now going to pick up the probability of occurrence and multiply this with the outcome. So we captured this particular situation, and then we are going to do the same thing for the second possible possibility and the outcome. And actually, I don't need to do this repeatedly. If I copy these through, as you will see, all of these are multiplying B and the C column entries in here, and this is actually what I want. So let's tidy up this a little bit. Let's put these maybe 4 of decimals. Now we are going to sum these up. Remember, we multiply the probabilities and outcomes and then sum them over. So sum of all of these is going to be, we can use the sum function. We will highlight all the entries in this array, and then we will close parentheses. We got 12% expected return. So probability weighted average of these outcomes is 12%. So this is expected return for asset A. So we will do the same thing for asset B. Let's copy this just to save time. And I will fit this into this range. This time we're going to change this to asset B. But we will do pretty much the same thing that we did before. So we will pick up the probability, multiply that with the outcome that asset B is going to have if this state of the world occurs. And then we are going to copy these through and then sum them up. Again, we could tidy up a little bit, 4 decimals enough, and then we will sum all of these, and we will get what we want. So we got 14%. Again, we can turn this into a percentage. So the expected return of asset A is 12%, and expected return of asset B is equal to 14%. So we could write here A, our answers, expected return A is, we can just pick up from this in here, 12%, and expected return B is equal to 14%. So this is probably the easiest way to do this, but I could also use a slightly different approach. I could, let's say in this cell, I can calculate these by just picking up probability times outcome 1 plus probability 2 times outcome 2, to put them in parentheses in order not to make a mistake. So the third probability times the outcome plus fourth probability times the outcome. Let's put them into the parentheses. And finally, we are going to pick up the fifth probability and multiply that with the fifth outcome. So if I just hit enter, that is going to give me the same result that I got in here. This means that probability weighted average of these returns is equal to 12%, which is the expected return of stock A. So I am not going to do the same thing for expected B. I will leave this as it is because it's pretty much the same thing. So let's go to the calculation of standard deviation. So in order to calculate the standard deviations, what we'll need in here, let's call this column as squared probability times squared deviations from squared deviations from the mean. Okay, so let's call this probability times squared deviations. or we could just simply say expected, or the outcome minus expected return and squared. So probability times outcome minus expected return to the power 2 for let's say column A, or we can do this for asset A. So let's fit all of these into this column. So what we will do is we will go pick up the probability of occurrence. We will multiply that with the outcome, which is 10% in this case, multiply, subtract the expected return that we calculated in here. Since that is going to be always the same thing, we are going to fix that. We will do F4 to keep this fixed. And then we are going to take the second power of this. So this is the probability times outcome, which is minus 10%, minus expected return, which we calculated as 12%, squared. So if we enter this column, actually calculate that. And I would like to do one more thing. Well, let's copy this through. If you copy this through, you will get all of the squared outcome. Let's do and four decimals in here. So deviations from the expected squared times probabilities. And if I take the sum of all of these, sum of all of these squared and probability weighted squared deviations, I am going to get the variance of the returns. So this is the variance, but I need the standard deviation. So in order to calculate the standard deviation, I need to take the square root of this. I can do this in two different ways. I can either use the square root function or just simply take the square root of this outcome in here. So if I want to do that, I will just simply open up a parenthesis in here and say power 1/2, that is equivalent to the square root, and that is going to give me 12.20% as standard deviation. As I mentioned, I could also just simply use, instead of doing this, let's clean this up, we could just simply take the use the square root function, SQRT. That would produce exactly the same result. As you can see, we got the same result in here by using the square root function. So we will repeat the same thing for this time asset B. Let's do that in here. Again, let's fit this into this column. I can actually make this a little bit easier. I could just simply write this function here again. Probability times the outcome minus this time the expected return of B squared. I want to fix this because this is not going to change, but everything else is going to change in the equation. So I did this one, and if I copy this through, I will get exactly what I need, and all I need to do is just to do the same thing. I could actually just copy and paste it in here. It would do the work. So let me show you this. If I take this and copy in here, it automatically calculates what I need. But let's do it again. So what we need to do is sum all of these square deviations, which gives me the variance. And now I'm going to take the square root of these, SQRT of these square deviations. Oops, did something wrong here, I believe. Sum of all of these things that are here. So I got 20.35%. So standard deviation of asset A is right here, 12.20%, and standard deviation of A and standard deviation of asset B is going to be what I calculated here, 20.35%. So we have the expected returns and standard deviation. So these are telling us what return we should expect, and these are telling us about the risk of the asset. In part C, we are going to calculate the coefficient of variation for each asset. So say coefficient of variation of asset A, which is going to be equal to the standard deviation of asset A divided by expected return of asset A. So as you can see, it is slightly about 1, and then we could simply do the B in here, coefficient of variation of asset B. This time we're going to go ahead and pick up the standard deviation of asset B and divide that into the expected return. And we got, let's tidy them up again. The coefficient of variation of asset B is around 1, and coefficient of variation of asset B is 1.45. What do these tell us? For every unit of return, I take about 1 unit of risk in the case of asset A, but for each unit of return for the asset B, I'm taking about 1.4 units of risk. So in terms of risk-return trade-off, obviously this one is better because I'm taking less risk to earn the same amount of return. So comparing A and B, definitely A is a better choice. So it has this asset A has a better risk return trade-off. Why? Because it is smaller, right? So smaller coefficient of variation is better. Now let's do the Sharpe ratio. So for Sharpe ratio, we need, in addition to the expected return and standard deviations, we also need the risk rate of return. So Sharpe ratio of asset A can be calculated as simply ratio of expected return of asset A minus risk-free rate of return, which is 2.5%. So in order to write 2.5%, I'm going to write 0.025, or I can just simply write 2.5%, but I'll put it in decimals in this case, the same thing, divided by the standard deviation, which is 12.20. So as you can see in here, let's make this 2 decimals. So standard Sharpe ratio of asset A is 0.78. What does this mean? This means that for each unit of risk that we take, we earn 0.78% excess return, or 0.78 units excess return. So for every percentage risk we are taking, we are earning 0.78% excess return. Let's look at the asset B's Sharpe ratio. we are going to take the 14% minus again 0.025% or 2.5% divided by the standard deviation of the asset B. In this case, we have a lower Sharpe ratio. So Sharpe ratio of asset B is 0.57. This means that for each 1% return I'm taking, I'm earning 0.57% return. So again, from a risk-return trade-off perspective, asset A has a better risk-return trade-off. So as you can see, both coefficient of variation and Sharpe ratio are telling us the same story. Therefore, in part E, we can say that yes, they are consistent. We get the same. Investment advice. So this is it. This was all about this question. It helped us just to consider couple of basic ideas, two calculations that are really a little bit computation intensive in here, but everything else is really very simple. So I will stop here. In question 2, we were given a group of companies, their beta, which is the systematic risk indicator for these companies, or systematic risk measures for these companies, and the expected returns associated with these stocks. So the problem we have to see if we should consider investing in these stocks based on the expected returns that we have in the list in here. So in order to make that decision, what we need to do is just to determine the required rate of return for each of these assets based on their respective risk. So what we need to do is just to calculate the required rate of return for each of these assets. Required rate of return. Remember, required rate of returns are estimated by using a model where we call it SML model. If I may just insert it in here quickly. If you remember, the required rate of return for an asset should be equal to risk-free rate of return plus the systematic risk of that asset. So we could just put in here the symbol beta times the market risk premium. Right. So given an asset's risk and the price of risk, let's also make this more, let's say, appropriate by using subscript in here. So risk rate of return plus risk of the asset, or measure of risk of asset, times price of the risk gives us the required rate of return. So if the required rate of return, which is the bare minimum return that we should earn to get compensated for the risk that we are taking, is smaller than the expected return, we should invest in this asset. If the expected return is not high enough to cover our required rate of return, then we should skip investment. So let's take a look at first the required rate of return for each of these assets, and then we are going to make a decision. So to calculate the required rate of returns, what we need is the risk-free rate of return. Since the risk-free rate of return is going to be the same for all of these assets, we could do one of two things. We could either keep them in here and simply fix this by using F4. Plus, we are going to take the company beta, which is, for instance, for Apple is 141, times we're going to multiply that with the market risk premium. Again, it is going to be the same for all companies. Let's pick up this one in here, D12, and let's fix that too. So the risk-free rate of return and market risk premium is going to be the same for all companies, but beta is going to change. So in this case, I fixed the risk-free rate of return. It is going to remain always as D11, which is 3%, and the market risk premium will always remain as 6% even when I copy this through in here. So let's enter and organize this a little bit. So Apple required rate of return is 11.46%. As you can see, an investor who plans to invest in Apple stock expects to earn 15% return. Since the expected return exceeds required rate of return, this is a legitimate investment. That is, the investor gets sufficiently compensated for the risk that they are taking, even earning a slightly higher return on it. So let's write a column in here. Let's say investment decision. So we will decide whether we are going to invest or not. In Excel, actually, there is a nice function that you could use just to do something like this. There is a logical function. I'm going to show you how to do this in here. We will say if, this is an if statement, so it is a function if, open parentheses, and then we are going to conduct a logical test. Our logical test, if the expected return exceeds required rate of return. If this condition is satisfied, we are going to say in hyphens in here, these quotes, we are going to say invest, close quote. If the statement is correct, in that cell, we are going to have invest. And if this statement is wrong, then again, quote, we will say don't invest, close quote, close parenthesis. And the Excel is going to run this logical test. It is going to look at the expected return, which is in cell D3. And then if it sees that the D3 is larger than the required rate of return, which is in cell E3, it is going to put invest into that cell. If it is otherwise, it is going to put don't invest. So let's see if it did it right. It should show up there as invest. See, as expected, the decision is invest because expected return exceeds required rate of return, right? So I'm going to copy through these to calculate the other required rate of returns. As you see, I did it only once, and I could easily copy these through to calculate all other required rate of returns. And I created the test in here, or investment decision check. So let's look at, for instance, this second case where the expected return on Adobe systems is 7%, but the required rate of return is 7.98%. Obviously, in this case, since the expected return does not sufficiently compensate us for taking this risk, which requires a 7.98% return, we are not going to invest. So if I copy this in here, logical test will tell me that I should not invest. And actually, I could do the same thing for the third company. Analog Devices has an expected return of 12%, required rate of return of 11.40%. Yes, expected return is marginally higher than required rate of return, so it should be an invest. And let's see if it is correct. Yep, we got invest. And then we could check this one in the Chesapeake Energy Corporation. Required rate of return is 14.04%, but the expected return is only 5%. Obviously, it doesn't nearly cover the risk that we are taking, so we should not invest. So let's see what results we get. Don't invest as we expected. And we can copy this through in here. So all of the decisions are just automatically shown in here. In this case, again, if you can double check, the expected return is less than required rate of return, don't invest. In this case, expected return of 10% exceeds required rate of return 8.70%, so we will invest. As you can see, our investment decision is correctly listed in here. And as I told you, we use then logical statement in here. Excel is great for this type of stuff, so you can learn how to do this. This is a simple example of that. The bottom line is that the SML or security market line gives us the required rate of return, and if the expected returns are above the security market line, we invest. If they are below the security market line, we don't invest. Let's show this with a graph. So we are going to create a graph in here. Let's do a create a two-column data in here. This is beta. And this is the required return in this column. So we are going to use a hypothetical set of betas. Let's start with 0.25. And when the beta is 0.25, by using the risk-free rate of 3% and market risk premium of 6%, we can calculate the corresponding risk-free, the required rate of return. So we will use risk-free rate of return, and we're going to fix it again in here. F4 plus, we are going to multiply beta with the market risk premium. Again, we are going to fix that one in here. And so when the beta is 0.25, required return is, let's write this down as 4.5%, right? So for a company with beta of 0.25, required rate of return should be 4.50. And let's increase this with an increment of 0.25. So we will pick up this one and add 0.25 to that. Oops. A little mistake in here. So this gives me the 0.5 beta. Let's use this. Let's center these in here. Oops. .25 plus 0.25, it is 0.50. And if I copy this in here, it will just give me the required return for 0.50 beta. And I'm going to copy this all the way to see betas of, let's say, 2.5. And then I'm going to copy these to get through the required returns corresponding to these. So I have betas in this column, and I have the required returns in this column. Okay. So I'm going to create a graph in here, or maybe we could just do it in here. Let's insert a chart. I'm going to just do a blank chart in here. And if you right click, you can get the select data, and then we will say add variables. Let's call this SML line, or securities market line. And then we are going to use required rate of return in this case. And then we are going to put the x-axis, the betas. Just cover this, and we can just show this in here. As you can see, we just put together a line. This is the SML line, security market line. For each level of beta, we have the required rate of return. Maybe we can just do this a little bit nicer. We can add, let's go to the format data, and we will just put markers in here. Let's say marker options. Let's use red for the marker options. So for each level of beta, as you can see, I have the required rate of return. So these are just a fair compensation for the level of risk that we are taking. So if an asset return shows up above, we are going to invest. So we will call this this part of the chart investable assets chart. So let's insert a text. Let's call this investable. So any asset that falls into this region is going to be investable. Let's see if we can get rid of the outline in here. No. Line in here. Better. So this is the investable asset domain, and then the bottom part of the SML line is going to be not investable. So let's also put that one in here. So these are not investable. For instance, if we look at the relationship in here, the Apple analog devices and 3M are above the SML line. For instance, Apple has 1.40, somewhere around here, beta, and it has slightly above its required rate of return is somewhere around 11.46, but Apple offers a 15% return. That means it is somewhere around here. So we could just maybe again copy and paste this thing. And we can see maybe Apple stock is somewhere around here. Or something. I think let's make this smaller. So Apple stock is somewhere around here. Again, we have analog devices very close beta, and this time has a required rate of return of 11.40%, similar to the Apple's, but it has a slightly lower expected return. So if you have Apple in here, analog devices pretty much will be slightly below in here. And then 3M is does have 0.95 beta, somewhere around here, and its its expected return is 10%. Required rate of return is 8.70, but it has a 10%. Maybe it should be somewhere around here. So we could just copy and paste it here. Let's see if don't know where it go. So I'm using some software that just limits my my copy and paste. Yeah, right in here. So this is going to be 3M. 3M is somewhere around here. Its beta is 0.95, which maps the 0.95 is on this blue line. The 8.7 is on this blue line, but the expected return for 3M is about 10%, so it is above the line. So these are on investable territory. But others like, for instance, Adobe Systems fall into in here. Adobe Systems has 0.83, somewhere around here. It's beta, and its required rate of return is almost 8%, but its expected return is 7%, somewhere around here. Therefore, it is not investable. So we can maybe again copy and paste this in here. So we could just put the other way somewhere around here, right? It is not investable because its expected return is below its required rate of return. So Adobe is below the line, therefore it is not investable. So we could show the investables and not investables in this fashion in a graph. But the idea is that any company that has, or any asset that has an expected return above required rate of return is investable. Others should not be invested because they do not earn sufficient return for the risk that they are that the investor is taking. So does this remain always like this? Well, if somehow things change in the market, and if these expected returns increase, this is unlikely to change unless market conditions change. That is, the required rate of return will not change unless market price of risk and companies' riskiness and risk rate of return does not change. So if the macroeconomic environment remains the same, but if for some reason, for instance, when the Adobe Systems price goes down, because people are not going to be buying this stock, and since expected returns are lower than the required rate of return, a lot of people would like to sell this. When they sell it, share price is going to go down, and the declining share price might increase the expected return to a higher point where this becomes an investable at some point. But as it is now, the Adobe is not investable with these parameters. So with that, I'm going to stop this explanation, and I hope this was helpful. So these are the two quantitative questions in the homework. I provided the answers for the 3 and 4, which were conceptual questions in the solution. So I'm going to stop in here, and hopefully this will be available.